You may save money by taking a boating safety class or joining a watercraft association or by bundling your policies with your carrier. The next area is life insurance. And one thing we want you to do is update your life insurance beneficiaries. That right now, Tyler's policies list Mia as the beneficiary, and Mia's list Tyler as a beneficiary. That's great. But you should also have contingent beneficiaries, and in case, and possibly in order a third choice, or even use your trust as the last beneficiary if necessary. We recommend that you purchase additional life insurance, especially Tyler. Um, and currently he has 168,000, but that's really not enough in our opinion, because um, you'd want it to cover your mortgage and help out if something, and have income replacement, and to help out with Becky's education. And so we are suggesting a 1.5 million policy, and that will cost $1,600 and $1,600 approximately. And Mia, we're suggesting 300,000, and that will cost approximately $338. Um, there's different ways to save on life insurance, and we're suggesting a term policy, and that would be not through work, because in case you change employers, and but you could get it through work, and it would be cheaper. So, and you may have to take a medical exam. So let's moving on to disability insurance. Disability insurance helps replace a major portion of your income when you're sick or injured and unable to work. Some people think of it as a paycheck protection. Others view it as a way to protect their home, since a mortgage payment is often the family's most significant monthly expense. So disability insurance can provide a sense of security, knowing that if the unexpected should happen, you'll still receive a monthly income. And so, and if you think about it, everything you have today, your home, car, groceries, savings, basically your lifestyle, depends on your ability to earn an income. So most people are quick to insure their possessions, such as their home and car, and they generally have life insurance. But one thing that makes it all possible is your income. So it's one of your most important assets. And in Missouri, there is no state disability insurance, so you have to rely on private disability insurance. So, something to consider, and what we're recommending is that Tyler get 70% of his income, because right now he currently has 60%, and it would be really hard to live on 60% of his income. And we are also suggesting that Mia look into an own occupation policy versus a modified own occupation. But that's something to consider, and we will get into it further in the plan, kind of a lot in the plan. And if you have any questions, you can always call, and we'll discuss it and explain any section that you want. The next area is long-term care insurance. And a lot of people think that Medicare covers long-term care, but it doesn't. It only picks up 11% of nursing home costs nationally. And the other insurance that people think about is Medicaid. But basically, Medicaid will not kick in until you have exhausted most of your assets. Basically, you have to be destitute. So, a comprehensive long-term care policy is the best defense against the cost of a catastrophic illness, and will preserve the assets you want to leave to Becky. And it is much less expensive to buy it when you're young and healthy than when you're older and you need it, because they may not sell it to you when you need it. And the costs, when we last spoke, you had mentioned that you thought that the cost for a nursing home stay annually in Missouri was $49,000. We did further research, and a semi-private room in a nursing home in Missouri is on average $62,000 annually. For a private room, it is $73,000, which is much higher than what you had mentioned. So we are suggesting that you get long-term care insurance. The projected cost of long-term care in Springfield when you turn 79 for home care for 2 years is $487,000 for 2 years. A assisted living facility for 3.5 years will cost you $575,000. A nursing home for 3 years would cost you $1.3 million for 3 years in Missouri when you turn 79. So we have a little chart here that discusses how we got our facts, and that's also part of the report. And so it's something you should seriously consider because it is much less while you are young than when you are older and need it. And people who don't need long-term care assets are people with substantial assets because they can pay out of pocket. People who would qualify from the federal Medicaid program, which means you are really poor. And people who have moderate assets and are willing to spend down those assets on long-term care to near poverty levels at which Medicaid would pay the balance. Based upon what we talked about, I don't think that's you. A long-term care policy for both of you will cost approximately $94 a month for a total of $1,128 a year, and that's for a 3-year benefit period. And so anyway, there's more details in our plan. The next area is homeowners insurance. Currently, you have a HO3 policy with a $100,000 liability limit, and your home is insured for $225,000. So what that means is $100,000 is if somebody sues you, that's how much they're willing to cover it for you. If your home itself is insured for $225,000, so if a tornado came in and took away your home, they would cover it because you have a replacement value on the contents. But we're suggesting you get $300,000 liability insurance, which is probably the minimum, and you may have to increase that amount for your umbrella insurance coverage because you need certain minimum liability coverage. The other area that we think that you need coverage is an inflation endorsement on your policy and a endorsement to cover your jewelry, your paintings, your china cabinet, your golf clubs, your collectibles, and your harp. So some of these may require an appraisal before the rider is granted, but there's more details in our plan. And there's ways to save on insurance. One is bundling. So you're going to hear bundling because you get them all under the same insurance company and you will save money, usually. And the next area is auto insurance. And Tyler mentioned that he has a ticket that he received within the last 3 years. That affects the cost of your insurance. So he may want to go and contact your insurance company and find out how you can save money. One way is maybe going to traffic school and reduce the cost of your insurance premiums, sometimes as much as $500. So it might be worth making a phone call, finding out what needs to be done to reduce those costs. Health insurance. Right now you are paying $300 per month on health insurance. So we're suggesting you use it for preventative care and for your family's checkups. I mean, you're paying for it, you might as well use it. And the other way we were thinking that you could save is by contributing $1,000 pre-tax to an FSA, flexible spending account. You collect all of the receipts and the explanation of benefits, submit them to the FSA company, and they will reimburse you. And based upon your annual expenses for last year, you spent $1,080. So we're suggesting you contribute $1,000 this year, and you would save approximately $300 on income taxes. And so that's $300 in your pocket. The other area is on insurance is you may want to consider pet insurance for your dog since he's 5 years old. It would be approximately 35 years in dog years. We're recommending that you think about it. We've listed the cost as part of your discretionary expenses, and it's up to you if you want to get it. But we just thought we'd research it since you have a dog. The next area is taxation we're going to cover. And you can save on the one way to increase discretional income for savings is to reduce your income taxes. So currently your itemized income tax deductions consist of federal taxes withheld, state taxes withheld, property taxes, a portion of your Missouri vehicle plate and tag tax, mortgage interest, and your charitable donations. We recommend that you make more pre-tax contributions and get more itemized deductions so you can save on income taxes and have more money available to you. It will mean more money in your discretional income and more money for you to save for retirement and Becky's education. So one way is by maximizing your 401k contribution. Currently, you contribute a total of Tyler contributes 4108, and he can contribute up to 17,500, and Mia contributes 3250, and she can contribute 17,500. The more you contribute up to the maximum of 17,500, the more you will save on taxes and meet your goal for retirement. So if you were to maximize your contributions for a total of $35,000, which seems like a lot, pre-tax, you would save $10,500 in taxes. And this is actually achievable based upon our numbers and cutting expenses. But it's really up to you and what your decision is on how you want to spend your money and what changes you're willing to make. Okay, the second area is you need to claim the $118 that I mentioned earlier for the company paid group term life insurance policies that are paid by your employer. So Tyler has anything over $50,000 paid by an employer needs to be claimed on your income taxes. So the total for both of you would be, it would result in $118, which is small. Let's see. So we're just telling to claim it so that way you don't get audited and there's issues there. There was a concern about Tyler's FICA error, and we think it was based upon 2012 tax laws, but 2013 it's no longer an issue. So I wouldn't worry about that. Let's see. The next area is charitable deductions. Rather than giving cash, we are saying you might want to giving Becky's old toys if they're in good condition, or clothing that's in good condition, and get a receipt. The other way so that would be a tax deduction. The other area is to consider donating long-term investment assets instead of cash. There's no capital gains tax on sales or donations of securities that have appreciated. But make sure that you give assets that have been held more than a year, because you want to be able to get the fair market value for that. And otherwise you would get the basis of whatever the short-term capital gains are. So it's better to give something that has been held more than a year. I talked a little bit about the 529 plan, and with that, if you were to save for Becky's education, you could get up to $16,000 tax credit in Missouri for married couples filing jointly. Okay. I talked a little bit about the FSA, so we've calculated that you should put in 1,000, and we also suggest that you, let's see, for the U.S. savings bonds, we're saying that they may accrued interest taxable in the future, may be tax-free if bonds are used for Becky's education, provided you meet the AGI requirements. So there is a threshold for your adjusted gross income, and depends on how much income you have. So one way of reducing your AGI is by contributing to your retirement and doing the FSA and doing the tax credit, which we're going to talk about in a sec.